everyone, I'm Natalie Trout. I'm a wealth advisor with Elevation Wealth Partners, and this is the August Elevation Market Update. Today, as a guest, we have Kara Murphy, who is the Chief Investment Officer of our partner company, Kestra. She is also a certified financial analyst. She lives with her family in Austin, Texas. Welcome, Kara.
Thanks so much for having me. I appreciate it.
Yeah, so today we're going to take a look back at what's already happened in 2025 and then what we are anticipating for the last few months of the year. So as we enter those final months, let's look back at what happened. We've experienced a lot of volatility, which was painful for some investors. What's your take, Kara?
It's kind of hard to believe how much has happened over the last 8 or so months. I was just checking this morning. The S&P is officially up 10% year to date. And I like to describe the earlier part of the year as like the Rip Van Winkle year. Because if you had gone to sleep at the beginning of the year, looked at your portfolio, and then woken up at the end of June and looked at your portfolio, you would have been like, I did a great job. But for those of us who were awake throughout that whole year, it was absolutely exhausting, stressful, everything, because we had a massive market drop. So the market dropped almost 20% after tariffs were announced. That's typically the marker that determines a bear market. So we were almost at a bear market earlier this year. And then lo and behold, stocks very quickly rallied. And then we're up 10%. And by the way, like what drove us down in the beginning was tariffs. And guess what? Tariffs are still around. And we're still talking about them. We're still driving headlines. But what's changed during that time period is that when the government decided to put most of the tariffs on pause, what that told the market was that the government was not willing to accept a recession in exchange for their trade policy. So what that means is that the government, the market is willing to give the administration time to kind of, change policy as long as they believe that the economy is going to continue to grow. And what we've seen actually is that in the second quarter, when a lot of companies started to report earnings for that quarter, they came in much, much better than expected. So there's a lot of momentum actually underlying the economy and the market overall, which is sort of remarkable given the huge drop that we saw in April.
Yes, so, you know, to put it concisely, it felt pretty bad for some people, but things are actually looking pretty good. And
Absolutely.
like you were mentioning, a lot of the volatility was due to political decisions that were being made, including the tariffs aforementioned. And now we are seeing Trump turn his focus to the Federal Reserve, which is they decide whether or not they're going to be interest rate cuts. And he's even threatening, I'm going to fire Jerome Powell. Do you think this could happen?
So I think the sort of saber rattling around the Federal Reserve has introduced a new policy risk for the market. So we wrote a piece on this a couple of weeks ago talking about like why is it important that the Federal Reserve remain independent? And when it was, if you go back to the Federal Reserve's beginnings about 100 years ago, it was because the US economy used to go through these huge boom and bust cycles. And in fact, you had private citizens like JP Morgan who had to bail out the government because of those busts. So the Federal Reserve was designed to sort of like steady the economy. And by and large, what you've seen is that the cycles that the economy has gone through has gotten narrower. Now, we can debate about how much of that was the Fed, how much of that was the maturing of the economy overall. I think it's fair to say both contributed to that. But part of what makes the Federal Reserve powerful is the idea that it's not beholden to political interests. So the risk we have now is that the more political pressure there is on the Fed to lower rates means that the market starts to think that inflation increases, which makes it harder for the Fed to fight inflation and do its job. So in a strange way, the more political pressure there is to lower rates, the harder it may be for the Fed to actually lower rates. And that's the risk that we run with President Trump sort of monkeying a little bit with who's sitting around the table and making those interest rate decisions.
Yes, the Fed is a really important part of our economy. So, zooming out to the general state of the economy, you hinted at this earlier. How is it doing right now?
So the interesting thing is when we look at most economic indicators, they're actually quite strong. And that's despite, the volatility and the uncertainty that's been introduced because of tariffs. So generally we look at a few different areas. One is what's the Fed doing? And the Fed's right now at about neutral, I would say. We also look at things like manufacturing. Manufacturing's actually been in the doldrums for about 2 years. And so it's continued to be at about neutral to a little bit negative, but again, like no change there. Then we look at consumer. Remarkably, consumers are actually quite strong. What we see is that people say that they don't feel great about the economy, but when we look at what they're doing, consumers continue to spend. Housing is one area that's downshifted a bit more recently. You've continued lack of affordability in markets, continued high interest rates. That's caused builders to really slow their building. And then the last piece is labor. And I know that's been an area that's been in the headlines a lot as well, partly because there were numbers that came out recently showing that a lot fewer jobs had been created. But by and large, we've been waiting for the labor market to weaken for a couple of years now, and it's really held in. So when we look at each of those different sort of areas of the economy, there's actually like a fair amount of momentum behind them, despite some of the headlines that you might see.
Yes, that's what's called headline risk, because all of those headlines are written to get a reaction out of the
Yes.
reader, whether or not they're exactly the truth. And some investors, in light of these fears, they are turning to gold as a hedge in this time of political and financial uncertainty. What are your thoughts, Kara? Should we all be flocking to gold?
So I'm not a huge fan of gold. Nothing against like the metal itself, right? But when I'm a big fan of looking back through financial history. And we have a lot of data to help understand how different asset classes perform through time. So, for instance, when we look back over the last 200 plus years, we're able to go all the way back to 1800. And in some cases, we can go back way before that even. But let's start the clock at 1800. And when we look at the performance of stocks, bonds, gold, what we find is that of those three asset classes, stocks have by far the best track record through cycles about growing wealth. Gold, interestingly, has spurts of time where it outperforms. But if you look over that long history, it actually has a really poor track record of being able to grow wealth. So it tends to be an area where people sort of hide and they can like gain some comfort. And I get that, I always give the example of my father-in-law who grew up in East Germany, escaped there after the war in the back of a farmer's cart, and he left with a couple of gold coins. And that like helped him start a new life, right? And when each of my kids was born, he bought each of them a couple of gold coins. And he presented them to us, and then they went right in the safe. We haven't seen them since. And I actually calculated from the time that my son was born, if he had just bought the S&P 500, we actually would have done better than in those gold coins. But those gold coins helped him sleep easy at night, right? So I don't begrudge him that. But as we think about the best path to be able to grow wealth over time, it's still some combination of stocks and bonds.
Yes, absolutely. Gold is tempting because it's physical, right? There's a
Right.
little bit more comfort rather than investments. They're just kind of out in the ether doing their
Yeah, and I
thing.
understand that. But if we want to grow wealth, we have to kind of get over that challenge.
Absolutely. So, looking forward, what are your predictions for the rest of the year?
So right now, you hinted at this, all eyes are on the Federal Reserve. And I would argue that the Federal Reserve's job right now is actually not all that difficult when we compare it to other periods like COVID or the financial crisis, sort of balancing their dual mandate of maintaining strong labor market and keeping inflation muted. It's not that difficult a choice, but you layer on the politics and it becomes much more fraught. So I think looking to the back half of the year, there's a good case to be made that the Federal Reserve should be cutting interest rates later in the year a little bit, not a lot. And so I think we'll probably see that. We'll continue to see this play out in the headlines. And then as we start to see the continued earnings momentum of companies, that's going to ultimately be the driver of what happens with the stock market. And so far, coming out of the second quarter, heading into third quarter, again, it looks like that momentum is really strong. The economy continues to be on solid footing. And so I think that generally bodes well for risk assets.
Yes, so hopefully we don't see any new policies that cause a lot of volatility, and we can just, you know, glide on through the rest of the year without any major events, is my hope.
It is my hope as well, but I always like to warn people like risk is part of the game, right? And so we always have to be prepared for some negative headline or some big surprise that's going to kind of throw us off course. And I think it's important to remember that's part of investing, right? And that's why we take a long-term view. Again, April, remember, we dropped almost 20% and then we're up significantly from there. So I think we build diversified, resilient portfolios that can still withstand a negative headline or a negative event.
Absolutely. If there was no risk, there would be no reward. If everyone could
100%.
invest and we all made money all the time,
Yeah.
that doesn't work.
I wish, because then I wouldn't have to go to the gym either. That'd be great.
That's the same deal there.
Yeah.
Yeah. So, any last thoughts for us, Kara?
So I think again, you hinted at this earlier. It's so easy to get pulled into these sort of like negative inflammatory headlines. We spend a ton of time just looking at like what's the data telling us? And the data is telling us that there's a good bit of momentum in the economy and into corporate earnings. And I think that's what has to be the sort of like guiding star of investors, not all of this kind of toing and froing that we see in the headlines.
Absolutely. Well, Kara, thank you so much for joining us today and sharing your insights.
Thank you.
Yeah, you're welcome. It's always a pleasure. Thanks so much for chatting with me. If anyone has any questions on what we've discussed today, or just questions in general, please feel free to reach out to us. Our next market update will be in November.